Hello everyone, I am Atika and I'm going to talk to you about course MB2203 Financial Management. On previous session, I have talked to you about two financial ratios. Now let's move on to the other ratios. So as we know that financial ratios have divided into five categories: liquidity ratio, activity ratio, debt ratios, profitability ratio, and the last one, market ratio. On this session, we will talk about the last three ratios. So let's begin with debt ratio. Debt is a very important thing in a company as it shows how much the firm uses other people's money to generate their profits. Generally, the financial analyst must concern with the debt because they want to know the long-term debt as it is the contractual payment over the long run. The more debt company has, the greater the risk. First, here we have debt ratio. It calculated by dividing total liabilities to total assets. So it shows you how much the company have an asset using their liabilities or using debt here. The more company use debt to finance their asset, they're using the leverage. The higher the leverage that the company uses, the more debt a firm has, the greater the financial leverage. Here, the financial leverage means that the magnification of risk and return through the use of fixed cost financing. The higher the debt ratio, the higher the firm has the financial leverage. Next ratio, here we have debt to equity ratio, which calculated by dividing total liabilities to the common stock equity. Still, high debt to equity ratio define that the firm has the high financial leverage. Next, we have here time interest earned ratios. The first two debt ratio here, it shows the data from balance sheet, right? Meanwhile, here the times interest earned ratios use the data from the income statement. So we can use both financial statements to look at the debt ratios categories. Next, we have profitability ratios. First, we have profit margin ratio, which is the gross profit to sales. So here we see that how much the percentage of sales remaining after we pay the goods. So we already subtract the sales from goods to get the gross profit and then divide it to sales. So the higher the gross profit margin, the better. Next, we have operating profit margin. Different to the gross profit margin, in operating profit margin, it's showing you the pure percentage of sales remaining after all the expenses have been deducted, except the interest and also the taxes. Pure as the operating profits shows you the actual or the operational of your business itself, excluding the interest and taxes. Similar to the gross profit margin, we want this ratio or the operating profit margin ratio to get higher, or the higher the better. And the last one here, we have net profit margin, which is percentage of each sales remaining after all costs have been deducted. Here we have the earning available for common stockholders, which is the very last part of our income statement. Similar to the other two ratio here, you want net profit margin to get higher, so still the higher the better. Still from profitability ratio, here we have EPS or earning per share. For earning per share, we look at earning available for common stockholders divided into number of shares of common stock outstanding. Usually this ratio is more interesting to the stockholders, prospective stockholders or the management, because it shows you the amount of money that earned during the period over the shares that outstanding or the shares that are available on the market. Next, here we have ROA or return on total assets, also called return on total investment. So it shows you how much earning that you have as a return from the asset. It's also measure overall management effectiveness, how much they can generate return by using their assets. So still in perspective of stockholders or management, the higher ROE are more preferred. And last one here we have ROE or return on equity, which is the earning available for common stockholders divided by common stock equity. Still, in perspective of the owner, they want to have high ratio in this one. Market ratios give you the insights of the investor out there. Investor in the market believe in a firm in terms of their risk and return. Here we have PE ratio or price earning ratio, which is calculated using the market price per share of common stock divided by earning per share. Usually this is more informative if you are comparing it using the cross-section analysis or you do the benchmarking. For example, you see the industry on average or you benchmarking it with the competitors, the firm's competitors, something like that. And last one here we have book value per share of common stock, which calculated by dividing common stock equity to number of share of common stock outstanding. The book value term here is really showing you an accounting value, the exact value of the firm's stock itself. So it is on the perspective of the report by using the financial statement of the firm, while the price earning ratio shows you the market insight. That's all for this session. I hope you learned a lot and find something useful for you from this course. I will see you soon for the next part. Bye.